What if I told you that becoming a millionaire is less about luck and more about a handful of principles that have been hiding in plain sight for over a century? What if the difference between staying broke and building real wealth comes down to how you think when everyone else is losing their minds? Today, we are diving deep into 5 investment tips that have built empires. These are not trendy hacks. These are not overnight crypto moonshots. These are battle-tested principles used by the most powerful investors in history. And here is the twist. Every single one of them is simple. But simple. If you stay with me until the end, you will not just hear tips. You will understand patterns. You will see how millionaires think. And once you see it, you cannot unsee it. Let's start with a mindset shift that changed everything for Warren Buffett. Think like an owner. Most people look at stocks as numbers on a screen. Green means good. Red means panic. They stare at charts like they are heart monitors in an emergency room. But Buffett never saw stocks that way. He saw businesses. When he bought shares, he imagined he was buying the entire company. Not a ticker symbol. Not a trade. A business. Imagine you are buying a small restaurant in your neighborhood. Would you buy it because the price went up yesterday? Would you sell it because someone offered you slightly less tomorrow? Of course not. You would ask deeper questions. Does it make money? Do customers love it? Does it have something special competitors cannot copy? That is how millionaires invest. Buffett famously avoided the dot-com bubble in the late 1990s. At the time, internet companies were exploding. Everyone was getting rich overnight. Teenagers were giving stock tips. Taxi drivers were talking about IPOs. It felt like a gold rush. And Buffett did nothing. He did not invest a single dollar in most of those tech companies because he did not understand how they made money. He openly admitted it. He said he could not clearly see their long-term value, so he stayed out. People laughed at him. They said he was outdated. They said he did not understand the future. Then the bubble burst. Billions vanished. Fortunes disappeared. And Buffett? He was still standing. Thinking like an owner means you only invest in what you truly understand. It means you zoom out. It means you ask, will this business still matter in 10 years? Buffett loves companies like Coca-Cola because people drink soda in good times and bad. He loves companies with strong competitive advantages, what he calls a moat. A moat is something that protects a business from competitors, brand loyalty, network effects. Apple is a perfect example. Apple does not just sell phones. It sells an ecosystem. Once you are inside it, leaving feels painful. That is a moat. That is why Apple became one of Buffett's largest holdings. Lesson number 1 is simple. Do not trade pieces of paper. Own pieces of businesses. Now, let me tell you a story that sounds almost too perfect to be real. The shoeshine boy story. It is often told about John D. Rockefeller. One morning, as the story goes, Rockefeller was getting his shoes polished. The shoeshine boy started giving him stock tips. He talked about returns. He talked about hot companies. He spoke like an expert. Rockefeller walked away deeply unsettled. He reportedly said, "If even the shoeshine boy is talking about stocks, it is time to sell." Shortly after, the market crashed in 1929. Now, whether every detail is historically accurate does not matter. The lesson is gold. When everyone is excited about an asset, danger is near. When people with zero experience start acting like experts, a bubble is forming. We have seen this pattern again and again. The dot-com bubble, the housing bubble in 2008, the crypto frenzy when Bitcoin hit extreme highs. At the peak, everyone is a genius. At the bottom, no one wants to talk about it. Think back to the last big market mania. Trends were posting screenshots of profits. Social media was full of overnight millionaires. News anchors were celebrating. Then prices fell. Suddenly the same people went silent. This is human psychology. Greed at the top, fear at the bottom. Millionaires learn to observe this pattern instead of getting trapped in it. When you hear investment tips from people who never cared about investing before, pause. When you feel pressured to join because everyone else is winning, pause. When your Uber driver gives you financial advice, pause. That pause can save you a fortune. But here's where it gets even more powerful. The greatest fortunes are often made by doing the opposite of the crowd. This brings us to lesson number 3. Contrarian investing. In 1815, during the Battle of Waterloo, the future of Europe was hanging in the balance. The Rothschild family had a vast financial network across Europe. Legend says that Nathan Rothschild received news of Napoleon's defeat before the rest of London. The market was in chaos. Uncertainty was everywhere. Instead of celebrating openly, he reportedly began selling. Others panicked and followed. Prices collapsed. Then, when fear was at its peak, he started buying aggressively. When the dust settled, he controlled massive positions at bargain prices. Whether embellished or not, the principle stands. Buy when there is blood in the streets. Sell when trumpets are playing. Contrarian investing is uncomfortable. It feels wrong. When markets crash, your instincts scream run. When markets soar, your instincts scream join. But millionaires train themselves to think differently. During the 2008 financial crisis, fear was everywhere. Banks were collapsing. Headlines predicted the end of capitalism. Many investors sold everything. Warren Buffett invested billions. He bought companies at discounts that would not appear again for years. Michael Burry famously bet against the housing market before it collapsed. People thought he was insane. They mocked him. They questioned his sanity. Then, the market crashed. He made a fortune. Contrarian investing requires courage. It requires research. It requires emotional control. But it can transform your financial life. Here is a practical way to apply this mindset. Pay attention to sentiment. Look at search trends. When everyone is searching how to buy a certain asset, you may be near a top. When nobody is talking about it, you may be near an opportunity. Do not blindly go against the crowd, but question it. Always question it. Now, let's talk about something that quietly builds more millionaires than any dramatic trade ever could. Time is the ultimate multiplier. Warren Buffett once said that time is the friend of the wonderful business and the enemy of the mediocre. Let that sink in. Time rewards quality. Time exposes weakness. Buffett's strategy is often described as buy and hold. It sounds boring. It sounds slow. It sounds unimpressive. But the numbers are staggering. Over decades, Berkshire Hathaway outperformed major indexes by enormous margins. Not because of constant trading, not because of predicting every crash, but because of disciplined, long-term ownership of great businesses. Let me show you the magic behind this. Compounding. If you invest $10,000 and earn 10% annually, in 1 year, you make $1,000. That seems small, but in the second year, you earn 10% on $11,000, then on $12,100, then on $13,310, and it keeps accelerating. Over decades, it becomes explosive. The problem is, most people interrupt compounding. They panic sell. They chase trends. They jump from idea to idea. Millionaires often get rich slowly, then suddenly. It looks fast from the outside. But it was decades in the making. Now, let me tell you about Aristotle Onassis. Before he became one of the wealthiest shipping magnates in the world, he was a young immigrant. He worked at a telephone company in Argentina. He intentionally chose the night shift because at night, due to time differences, he could overhear conversations between powerful businessmen from the United States and Europe. He listened carefully. He absorbed information. He positioned himself where opportunity flowed. When he heard about a company being sold, he acted. He invested. He profited. But here is the deeper lesson. Information is leverage. Environment matters. If you surround yourself with people who complain about money, you will absorb scarcity. If you surround yourself with people who discuss business and investments, you will absorb opportunity. Onassis understood that wealth is not just about capital. It is about access. Access to conversations. Access to knowledge. Access to networks. Today, we have something even more powerful than Onassis had. The internet. We can read shareholder letters. We can watch earnings calls. We can study the strategies of billionaires for free. But most people use the internet for distraction. Millionaires use it for information. So here are the 5 investment tips that can make you a millionaire woven together. Number 1. Understand the business. Invest for the long term. Number 2. Beware of bubbles. When everyone is euphoric, be cautious. When nobody cares, start paying attention. Number 3. Master contrarian thinking. Be brave when others are fearful. Be disciplined when others are greedy. Number 4. Respect the power of compounding. Start early. Stay consistent. Do not interrupt the process. Number 5. Control your environment and your information. Position yourself near opportunity. Listen more than you speak. But let me be honest with you. Knowing these principles is not enough. You must apply them. You must endure boredom. You must endure doubt. You must endure moments when others seem to be getting rich faster than you. There will be times when the market drops and your portfolio shrinks. There will be times when friends brag about quick gains. There will be times when patience feels foolish. This is where millionaires are separated from the crowd. They stay the course. They think in decades, not days. They measure progress in years, not hours. Let me ask you something. If you had invested consistently in strong companies 20 years ago and simply held them, where would you be today? If you had ignored the noise and focused on fundamentals, what would your net worth look like? Most people overestimate what they can do in 1 year. They underestimate what they can do in 20. The path to $1 million does not require genius. It requires discipline. It requires emotional stability. It requires clarity. Imagine looking back 20 years from now. Will you say you chased hype? Or will you say you built ownership in great businesses? Will you say you panicked during crashes? Or will you say you saw opportunity? The market will test you. It will tempt you. It will scare you. But it also rewards patience like nothing else on earth. $1 million is not a fantasy number. It is the natural result of consistent investing, solid returns, and time. You do not need to predict the next big thing. You need to avoid big mistakes. You need to avoid buying into euphoria. You need to avoid selling in despair. You need to keep learning. You need to keep thinking independently. You need to remember that wealth is built quietly. It is built when no one is watching. It is built when you choose discipline over dopamine. So here is your challenge. Start thinking like an owner today. Audit your investments. Do you understand them? If not, learn or reconsider. Start observing crowd psychology. Notice when hype feels overwhelming. Start building a long-term plan. Automate your investments if possible. Let compounding work while you sleep. And most importantly, upgrade your environment. Follow smart investors. Read books. Listen to earnings calls. Have conversations about money that stretch your thinking. The journey to $1 million begins with a decision to think differently, a decision to act patiently, a decision to step out of the herd. History has already given you the blueprint. Buffett showed you. Rockefeller warned you. The Rothschilds demonstrated it. Onassis embodied it. Now the question is simple. Will you apply it? Because the opportunity is still here. The market will rise and fall. Bubbles will form and burst. New technologies will emerge. Old companies will fade. But these principles will remain. Think long term. Stay rational. Be courageous when others are afraid. Let time do the heavy lifting, and never stop learning. If you can internalize these 5 investment tips, you will not just increase your chances of becoming a millionaire, you will transform the way you see money forever. And once your mindset changes, your results eventually follow. The market rewards those who respect it. The question is not whether these principles work. History has already answered that. The real question is whether you have the patience and discipline to make them work for you. Your future net worth is being shaped by the decisions you make today. Choose wisely. Think like a millionaire before you become one, and let time handle the rest.